Thank you, Sharma.
So participants are on mute right now. So is it okay?
Yes. Wahid, I think hope you are aware of that, right? Whenever they have questions. Shweta, can you change the setting to allow everybody to ask questions? Allow everybody to mute.
Okay, let me just change the setting now.
They will take care, Wahid, and they will take care of.
Yeah. Now participant can unmute and directly talk to you. Fine.
So I humbly request everyone to keep yourself on mute and do not open the video because it's being recorded and it will be uploaded on the YouTube as well. So it doesn't look good if somebody's video is open or somebody is talking in between. Okay, I hope I'm making sense. So good afternoon, everyone. First of all, I welcome you all in this session, which is about fund accounting. So briefly, we'll discuss about what do you mean by fund accounting, what does it consist of, and we'll little bit touch base upon what do you mean by private equity funds and hedge funds basics also, and we'll try to see the difference between these two instruments, these two kind of funds, I would say. Okay, we'll wait for another 2 minutes, then we'll start off. I think people are still joining, so we'll just wait for another 2 minutes and then we'll start the session.
So Sami bhai, do you have presentation? Do you want to share that?
Yes, I am starting. Sure. Hope my voice is clear and audible.
Yes, yes.
Can you see my screen?
Yes.
So what the people who have joined now, we are just waiting for another 1 minute, then we'll kick off. Just allowing the people to join. Just 2 more minutes. Okay, so we'll start off. Good to go, guys. Can someone confirm if my voice is good?
Yes.
Okay. So my name is Sami Owais. In total, I'm currently working with FX Fund Services based out of Hyderabad right now. And by qualification, I have completed MBA Finance way back like some good years ago. And I've completed while being on the job, I've completed my company secretary intermediate level also. And overall, I carry a good experience of more than 11 years now, close to 12 years, I would say, mostly into fund accounting, into the various companies across Hyderabad. Mostly they are like MNCs. So moving on, what do you mean by fund accounting? So fund accounting, as the name suggests, it refers to the maintenance of financial records. So whenever you're talking about like fund accounting, it is maintenance of financial records. When I say financial records, it consists of doing the accounting, creating the reports out of that, giving the suggestions, and what are the policies we are following around the fund. All the details would consist of the financial reports of an investment fund. So if I broadly have to categorize the things, what all comes under fund accounting, investment activity, that's what as an investor, when you invest some money in any company or in any fund, so all your activities, like how much you are giving, how much you are receiving, how much you are pending to give to the fund, and what all anything related to the investor, what we have to capture as a fund accounting. Portfolio activity is nothing but it's an investment activity which you have to record, and income earned and any expenses. So overall picture of this fund is there are two sides, guys. So always remember there are two sides. Fund is in between. I will give you an example of a fund like mutual fund. Just imagine a mutual fund. So for a mutual fund, on the left hand side there would be investors, are the people who are giving money to the fund, and in turn this fund will invest some other companies. Okay, so that's basically about the fund accounting. In other words, I would say fund accounting means it's a accounting of mutual funds, private equity funds, hedge funds. That can also be called as fund accounting. Moving on. What do you mean? One more slide. Okay, let's come to this slide. There are two types of investments are there. One are like traditional investments, another called as alternative investments. Earlier, if you used to see, we have investment into stocks, that's equities and bonds and cash. These are are considered as your traditional investments. Okay, the people would know about only these things earlier. They didn't have the idea about or they did not explore more things into the market. Now, as we are growing into the like at the global level, we are coming up with the new products. So new products includes these things. These are called as alternative investments. Something which is against or opposite to traditional investment are called as alternative investments. So what all comes under alternative investments is your private equity funds, your hedge funds, your real estate properties, your antique, right? Any statue is there, any painting is there, any art is there, artwork is there. Everything along coming as a alternate, they would come under alternative investment. So always remember, whenever you are talking about fund accounting, that's the accounting of these things are termed as fund accounting. Okay. So don't get confused when you see alternative investment and somebody is offering you a job under alternative investment department. So don't get confused. It is nothing but it is a part of, very much part of fund accounting. So moving on to understand what do you mean by private equity fund. If you guys understand how mutual fund works, I think most of us who are on this call can understand that. Mutual fund, right? We as good as 500 rupees we can give an SIP kind of thing, and you can start investing into a mutual fund. What the mutual fund does, that will collect the money from the people, and it will in turn invest into some other companies, and it will give you the returns. For that, it will charge some fees. Okay, that's about the typical structure of a mutual fund. Private equity fund also same thing happened there. Private equity funds basically invest into private companies. They mostly target private companies and invest into private companies. And if at all they are investing into public companies, they will make sure that they are converting that company into the private company. The reason being they want to keep themselves private is they don't want to show off, like they don't want to show off their investment to the general public. You guys know it, right? When we're talking about the company or the any other form of business, wherein it becomes like necessary for you as per the regulations that you need to publish your financial reports into the newspaper. But in the case of private equity, there is no such case. They don't have to do such things. They have to report financials, but to the directly to the government side. They don't have to do it to the public. Just a moment, guys. So that's about a private equity fund. Most of the private equity funds are termed as venture capitalists. So who are venture capitalists? Venture capitalists are the people who has got some idea, but they don't have any funding. The best example I can give you is about the Facebook, right? Facebook had a great idea. They just wanted to change the world with their idea, but unfortunately, but not having the funding, they could not move forward. So people like fund equity owners, the fund houses, or big financial institutions, what they do is they search for such people, they invest into them, and they buy some stake they buy some stake and take the ownership of that particular idea or the venture capitalist firm. Then they will enter, and if idea clicks, then both the parties will be in a win and win situation. So that's about the private equity fund. They invest in private companies, and they would buy some companies which are like not performing well also. In detail, we'll discuss in the coming slides. About the hedge fund also very similar to the your private equity fund. They also collect the money from the people, and here also amount involved is very high. As small as 1 million is the minimum amount they would ask from the people. That's the reason not everyone can invest, and only accredited investors can invest into hedge fund or private equity fund. What do you mean by accredited investors? It is nothing but it means those who have a good financial background, those who understand that how the things work into the financial market, and those who have risk appetite. In case of everything is going into loss, it should not affect them. So those kind of people with a good background, good financial background, are considered as accredited investors. Similar to private equity fund, they are also not subject to many of the regulations, and they have very few regulations, but they are binded by the regulation, but at the low level, and they do not have to show anything to the public, but they have to be transparent to their shareholders or the investors. They are not bound to show anything to the outside world. So that's about the hedge fund. Moving on, we'll understand what is the difference between private equity and hedge fund. So this is a typical structure of a private equity fund, wherein if you look at this, this is the structure of a private equity fund, wherein there would be one general partner. General partner is nothing but it's a fund manager who manages the fund. For example, just in Indian context, if you are talking about, or else I can take a name of a big private equity fund player, that is the BlackRock. I always take example of BlackRock. So BlackRock is one of the financial institution which has a good capture over the private equity funds and other instrument into the market. So what they do, they introduce a fund. For example, ABC fund they have introduced. Okay, this is the fund. For example, fund 1 they have introduced into the market. So what they do, they have come and ask to the people. They would ask the people, boss, I have started this fund. If you guys are interested, let me know. I can take you in. Then, so that BlackRock person or whoever managing from the BlackRock side, that person would be call it as general partner. So general partner is nothing but you can call it as a fund manager, or you can call it as a portfolio manager. So it is a responsibility of the portfolio manager to take care of the fund, everything, taking the decisions, where to invest, how much to invest, and what would be the expenses, what would be the different methods need to be followed. Every details or every things would be decided by the general partner. And who can be the LPs? LPs are nothing but the limited partner. each of the what do you call investor is called as a limited partner. So this is fund manager. These are the investors. So investors in private equity are called as limited partners. So mostly, who would be the limited partners? Limited partners can be the pension funds who have got a lot of money, and insurance companies. You know about insurance companies, right? They have a lot of inflow of money, and other funds, and other fund of funds, other big funds, other mutual funds. Okay, high net worth investors like people who carries like billionaires and all. Family offices. Family offices are nothing but the like people like they create like a family trust sometime, and everybody would put in money there. So endowments, foundations, sovereign wealth funds, government sector, they would be the investors for their any private equity fund or a hedge fund. I hope I am clear so far. Anybody has got any questions, they can quickly unmute themselves.
No, perfect. Thank you.
Okay, thanks. Thanks for confirming. So moving on, now what they have done, they have negotiated with them and talked to the limited partners, everything has done. Now these people have become a part of this particular fund. For example, just say 20 people have shown interest and they were a part of this fund one. So what would this fund do after collecting money from the people? What they do is they invest into different funds. So this fund can be your direct private equity fund, or it can be another private equity fund. So what I'm saying here, it will invest into any private company, or it will invest into any other private fund, private equity fund. Okay, so there are two things here. One is they are collecting money, collating money, and they are investing into another private equity fund, another private company as such, buying their good stake and taking over the ownership of that company, or they can invest into another private equity fund. For that, now you guys might be wondering like what they would get out of that. Doing all these services, what is the benefit to them? So they would be eligible to get a management fees. Okay, usually 2% of the committed capital. So they are eligible to get the management fees. They are also eligible to get the performance fees. We'll discuss when we move on to the next slide. Now looking at the stages of a private equity fund. And guys, remember, always remember, these are the stage as per my understanding and as per my knowledge. It can be differed. It can be, they can be using the different terminology, but the flow would be same, I would say. So what would be the first thing? The first thing would be commitment period. Commitment, we need to understand what do you mean by commitment. So commitment is nothing but when the fund initiates its activities, when they float into the market, when they start their activities into the market, they need some new players into the market, right? So when they do talk to the people, HNI clients, they go to the endowments, they go to the LIC kind of people, LIC kind of companies. They will reach out to other mutual fund companies, and they would ask them to make investment in this particular private equity fund. So what is commitment? Commitment is nothing but it's just a promise they have to give. For example, if I have to take the example, total fund, I am the fund now. I am the BlackRock company. I have started fund one. So I am aiming to raise like 100 million from the people. Okay, 100 million is my target or the fund size, that is called as fund size. I am aiming that. So some people have to give me the assurance that they would give me as and when I require that money. So person A would say, okay, boss, I am ready to give 10 lakhs. Another person B would say, okay, I can give you like say 30 million because I'm a big player. I can give you 30 million. Another person would say, C person would say, I would give you 20 million. Another would say 40 million. So they are just giving the commitment, right? They are not giving money here. They are just giving the commitment. It's a kind of promise they are giving that whenever you call it, we are ready to give away this amount. So that is called commitment period. So what happened in the commitment period? First, in the formation stage, what happened here? We found the LPs, we talked to them, internal team we have built, we build the strategy. Now what we do, we negotiate with them. Like boss, what would be the fees I'm going to charge? Okay. And what would be the kind of structure we have to follow? How you are going to pay money? Everything would be happening in the commitment period. Then comes the investment period. Investment period is nothing but it is the period when the private equity fund totally focuses on investing, because they have collected money in the first stage. Now they are focusing into investment. They have to do a lot of research now. They have to find out good avenues where they can invest money and get maximum returns. So in this period, they would focus mostly on where to invest. Okay, so that can be termed as your investment period. Then comes your harvesting period. As the word says, harvesting is nothing but it's a period when you start selling the investments. Okay, and if you look at that, it would happen somewhere here, 3 to 7 years, right? 3 to 7 years is the place where it happens that you start harvesting, you will start selling the investment, and you will get the money back and you will give it to your LPs. When I say you, it is always remember that I am referring to the fund, because I am the fund. If I am the BlackRock company, I am the owner of the fund. Then what I do, I take commitment from you. I make the investment into another companies, and harvesting period, I will sell off those investments. Okay, that is called harvesting period. Then would be the last stage, wherein the liquidating period. Liquidating is nothing but wherein they would sell off all the stake, whatever wherever they have made the investment. Now they sell it off everything, and they try to close the fund as soon as possible. So that is called liquidating period or the winding up stage. Okay, this is the typical life cycle. Also, you can say life cycle of a private equity fund. Any questions on this, guys? Do we have any questions on chat? Nothing. All clear? Can somebody confirm if it is all good?
Yes, Sami bhai, we are good as no one is asking the questions. We
Okay.
can further.
Thank you.
Yes.
So this is about the stages, or you can call it as a life cycle of a private equity fund. It is very simple, guys. Don't think that fund accounting or alternative investment accounting is something very critical. You need a lot of skills and all. Nothing like that. It is all about the conceptual thing. I do agree there are certain things, but overall, if I have to talk about, it's a very easy thing. It's just you need to understand the concept, how it works. Moving on to the strategies, like when I call it as a strategies, it is nothing but it is a place where private equity fund is investing. So as we already discussed and covered, they focus mostly on the venture capitalists. Venture capitalists are nothing but they are the startup. Okay, and they are also called as angel investors, like Zomato, Flipkart, Ola, Uber. These are all they are the people. They were not some big people, right? With a lot of money. They were the just pass out graduates kind of people, but they had great ideas with them. So private equity funds mostly focus on the your venture capital kind of setup. Next is the growth structure. Growth, when I talk about the growth, it is nothing but like investing into equity kind of structure. Equity kind of equity is the normal equity what we talked about, right? So it is about the growth fund, like wherein they want a regular income back in the form of dividend and all. So that would be the growth structure or strategy. Buyout is very important again. And there are two things here, LBO and MBO. LBO is nothing but the leverage buyout. You guys can write it down if you want. Leverage buyout and management buyout. So what do you mean by LBO and MBO? MBO, let me start with MBO. MBO is nothing but it's a management buyout. What they do is, you guys well understand, like equity shareholders are the real owners of the company, we always say. So in this case, private equity fund, what it does, they would focus on the investing into some public or the private company by buying some good stake of the equity shares. What do you mean by good stake? You guys must be aware, like if you hold more than 50% of the stake in any company, you become the decision makers because you hold the majority of the fund, majority of the shares, then automatically you become the people who can inspire the decisions, or you can take the decisions actually. So they do, it's kind of a takeover they do by entering into the another company. For example, if there is a very small company is running, say for example, Ola is running, Ola, and you find it very good opportunity. What do? You would give them offer, some good lucrative offer you would give them. Like if they are expecting some 10 crores, they would give an offer of 20 crores. Then obviously in such situations, the companies would sell off their stake to a private equity company. So what happens when you buy more number of shares here? You would be become the board of directors. You can have your board of directors who can take the decisions of the company. What is LBO? It's a leverage buyout. Leverage is nothing but the loan. In terms of finance, leverage is called as the loan, nothing but the loan. So what they do here is they give a lot of loan to the company. They don't want the board of directors seat here. In case of LBO, they don't want the board of directors. They don't want to become the owner, direct owner of the company, but they do want to influence the decisions of the company. So that is why they go indirectly, going through the route of by giving a lot of loans to the company. What happens? You give a lot of loan to someone, right? If your friend is there, you in your friend circle, you have someone, and you give loan to someone, what would happen? Tell me. They become humble in front of you, right? They would start respecting you, and they would understand and accept whatever you are saying, because you have given them loan. They have to listen now. So same things also here also happens in the case of private equity fund, wherein they would give so much of loan to the companies that they would become the people who can influence the decisions of the company, and they are not interested here in becoming the directors or taking the ownership, but they want to influence the decisions. That is your leverage buyout strategy. What do you mean by distress? Distress is nothing but it's a kind of companies which are about to close or not performing well, and there is no one to take care of that company. So in such a cases, private equity funds look for such companies. They would buy these companies, they would restructure that company, they would change the management, they would incur some more expenses, and ultimately they would sell it off that company. So that strategy is called distress strategy. If the company is a public company, they can turn that company into the private and they can sell it off that company. Then coming to the mezzanine, mezzanine is nothing but it's kind of unsecured loans, I would say, wherein there is an opportunity. If the company is failing to pay back, that would get converted into equity. Let me repeat that again. So mezzanine is nothing but it is a kind of unsecured loan. You give it to the company, wherein in case the company is unable to pay back, it would be converted into equity. And it is unsecured. First instance, you might be asking, like when you are saying that it is unsecured, why someone would invest into that? The only reason what I see is the rate of interest would be very high, because they are unsecured. Rate of interest would be very high, and this private equity or hedge fund kind of players into the market, they want to take advantage of such situation. So that's the reason they would invest into mezzanine kind of funds. Okay. First point, which point? Okay, venture capital, somebody is asking. Venture capital is nothing but it's a startup companies who do not have much funding, So they would always look out for some big players into financial players into the market, so that they can get the support, to take their business to the next level. I saw one of that guys recently. There is a person whose ad was running through on Facebook. That was a 2-year baby prodigy program there. Okay, this was the program that was running. I saw the ad in Facebook, and then later I realized that there is a show is going on, right? Shark Tank, right? Shark Tank. Can somebody type in what was the name? Is it the Shark Tank? So Shark Tank is nothing but it's a venture capital kind of things people are getting. So the people who are sitting, you can consider them as a opportunist who are investing into those venture capitalists. Can you guys give in the comment how many of you have seen that show? Or you can unmute and yeah. Think Tank, right? Think Tank, Shark Tank, what is that? I don't know. In India, right? It is being run. It was happening in the US and all, but India, they have recently started that.
It's Shark Tank, sir.
It's a Shark Tank, right? I would,
Right.
Yeah, thank you for that. And I would suggest everyone here listening to me to have a couple of have a look at the couple of episode of that, so that you would get understanding of what venture capital is. Okay, so they are the people who are getting the ideas, but they don't have money to take their business to the next level. That's the reason they approach the big financial players into the market, and they would and in turn they have to give some stake. Those who already watched, they must have seen, right? They would ask for some stake, 10% equity, 20% equity. So it is nothing but it's all about your venture capitalist strategy. Any questions, guys, so far?
Sami, can you please clear it out again about this?
Your voice is very low. Can you be clear?
Hello, is my voice audible to you now, Sami?
Yeah.
I was just asking this LBO and MBO, is it something similar to debt funding and equity? LBO, that means we can call it as a debt funding.
Yeah.
Or
You can say MBO is nothing but you would invest in more of the equity side, and LBO you can say investing into debentures or bond side more. Like it would go about like up to 90% also they would invest into here by giving a lot of loans. Yes.
In LBO, they will not have any equity. They will not ask for any equity.
Equity would be there, but they would give so much of loan that it could be like 90 to 10 ratio. So 90% of the loan they would give, and 10% equity would be there.
Okay, sir.
Okay.
Thank you.
Anybody else? One quick question. Can you put yourself on mute? Whoever was that? Who is that on mute? Unmute. Can the admins please make sure? Admins, can you mute whoever is unmute?
I think it's Ghulam Mustafa.
Yeah, Ghulam Mustafa, can you go on mute, please? Okay. Yeah, thanks. Okay, now something more for you guys. I've tried my level best to get you as much information as possible. So what's happening into the actual fund? You might be like thinking, right, listening to this, but we are not understanding how would be the structure, where it starts, what are the things involved, what are the stages and all. So this slide will talk about that. So it starts with the pool of money. Similar to mutual fund also, private equity and hedge fund also, they would involve pool of money. Pooling of money is nothing but the gathering of money from the more number of people. Instead of having only 1%, 2%, they would pool the money from the couple of people, and that is called a pool of money. And we have already discussed like accredited and high net worth investors. Not everyone can invest. In case of a mutual fund, you must have seen, right, as good as 55, you can start investing into company or any mutual fund. But in case of private equity and hedge fund, you need to be a high net worth individual, lot of money. In case of some losses also, you should have the good risk appetite so that you can absorb the losses in case. But usually losses do not happen, but you need to be a person of that kind that in case something happen, negative happening, you should be able to absorb that. Management fees, this crux, guys, this is the main thing why private equity or mutual fund or hedge funds are running into the market. They are charging management fees as a for managing the fund. Okay, this is the fees for which there are a lot of funds are coming into the market now. Usually 2% of the committed or invested capital. What do you mean by you must be seeing like it seems to be very low percentage, very small fees. If I ask you to calculate 2% of 10 billion amount, it would be huge sum, right? 2% would be a very big amount then. It goes into lakhs of dollars. So that way, it looks very small. Usually it stands at 2%. Sometimes we have seen 1% also, 1.5% also. Depending on the negotiations happened with the limited partners, this is fixed. Okay. And mutual fund, when it is charged, whether this fund is running into profits or losses, this management fees has to be paid. There is no rule that if fund is running into profit, we have to. Guys, I'll take a break of 2 minutes till Azan is going on. Be online, okay? Can you guys remove this person?
Yes, Sami, we have removed one person whose
Yeah,
sound was
please,
coming.
please keep an eye on such people. They
Yes,
always
yes.
come in between.
Yes, yes.
Okay, guys, let's start again. So we were talking about the management fees. So it's nothing but it is the bread and butter of the private equity or hedge funds, I would say.
Sami, could you please start sharing your screen?
Okay, sorry. I thought I'm sharing.
Sure, thanks.
Can you confirm you are able to see now?
Yes, it is visible now.
Thank you so much.
Okay.
So we were talking about the management fees, right? So it is nothing but it's the bread and butter of the any private equity fund or a hedge fund or the mutual fund. It is the main by which we also get money out of that, right? If you are working for any fund, then this will be the thing which will get our salaries and everything. The second thing what they get is performance fees, because they are doing a lot of research, they are taking risks. They have to talk to the various companies. They have to travel a lot of places. They have to go through the various legal things while setting up the funds. You have to look out for the tax-free regions, tax-free countries, tax-free cities, everything, and you need to understand the setup of the fund, everything. So you would incentivize them. That is nothing but you would by paying the performance fees. Performance fee is only applicable when the fund is running into profits, because if there is no profit, then there is no good performance by the company. So there is no question of paying them performance fees. In terms of private equity fund, this performance fees is called as carried interest, or it can also called as simply carry. Usually it stands at 20%. So that is why some websites or on Google, if you search about these funds, you would see there is something called as 2 and 20. So nothing but it signifies 2% is the management fees and 20% is your performance fees. Now moving on to the hurdle rate and preferred return. These two words are used interchangeably in this context of private equity and hedge fund. It is nothing but it's a minimum rate of return which every fund must give it back to their LPs to its investors. See, when as an investor, if I'm investing something, I would really expect, if I'm investing $1 million, then I would expect something above and beyond that amount, right? So same thing here also happens. If you invest in as good as your SBI, for example, into the fixed deposit, right? You would expect a return of 6 to 8% somewhere, right? Same thing here also happens when they invest. Investors would expect a return of 6 to 8%, and this percentage would be decided, and this percentage, everything would be decided at the inception of the fund. When the fund is about to start, this everything would be decided and negotiated between all the LPs and the GP. And that particular document is called LPA, Limited Partnership Agreement. Repeating again, it is called LPA. LPA is nothing but it's a Bible, people used to call. It's a Bible. It will contain all the details, like when is the launch of the fund date, what kind of fund it is, and where its registered office is, and who are the owners, what kind of fees they are going to charge throughout the life, what would be the policies they are going to follow, and what will be the conditions for the people who are coming late into the fund. Everything would be given in the LPA, Limited Partnership Agreement. They are less regulated when compared to the other your mutual fund and other public limited companies. That's the reason, because there is a lot of money involved. They don't want to show it to the public. You know, right, what happens when it goes to the public. If someone like investing like maybe $50 million, $50 million is a big amount, right? 50 million is a huge sum. And suppose that information is going into the public, then that would be very insecurity for them, for all the investors, right? Because people will get to know this person is possessing so much of money, then there are chances that there would be a lot of insecurity for that person. There's a chances of theft or some kind of attack on them. So that's the reason regulations regulations are very less to them, and they are very kind of close kind of environment they follow always. Everything would be given to the investors, but not to the outside world. Everything would be published and would be available for the investors. But outside world, it is only the fund information would be available. Initial closing and sub closing is nothing but the when if you guys remember the example, right, wherein we say that there is a fund started by the BlackRock, and it is aiming to raise 100 million from the people. What if they are unable to do that? What they get only partial amount? What if they got only 60 million out of that? So what they do, instead of waiting to make it 100 million, they would start off the fund with the whatever amount of commitment they have received. For example, 60 million commitment you have received so far out of 100. Then instead of waiting for the 100, you will start your fund. You will start your fund operations. Okay, that stage is called as a initial close. And after some point of time, like after 6 months or so, you got another some more LPs joined to your fund, and they have added some 20 million more. So now my total is 60 plus 20, it's 80 million now. So what I do, again, I do a close. That is called second close or the subsequent close. Or if after some time, after 3 months or so, I've got another LP who committed me 10 more million. So my total amount, how much is my total commitment now? 60, 30 and 10 million, right? 60, 30, 10 is 90. 60, 20 and 10, right? So it's 90 million. I do a one more closing. That closing would be considered as third closing. And after some months, I got another LP which will like satisfy my total amount, and it made the total of 100 million. Then that closing would be considered as the final closing. Okay, so closing is nothing but you stop at a point of time, and you close your books. When I say close the books, it's not about the accounting book. I would say it's closing the book of investors, finalizing the investors who is going to be a part of my fund. Okay, any questions on this slide, guys?
Sir, what would be the difference between a hedge fund and an alternative fund?
Alternative is the basket, I would say. Alternative investments is the basket wherein you will find private equity fund, hedge fund, commodities, derivatives. Those all will come under your alternative investments. See, something against the traditional investments are called as alternative investment. Make sense? Yes, no, who was that?
Yeah, sir, got it.
Okay. See, पुराने जमाने में आपको इन्वेस्टमेंट्स रहते थे, राइट? इक्विटी इन्वेस्टमेंट आपके पास रहते थे, बॉन्ड्स, डिबेंचर्स रहते थे, एंड कैश रहता था आपके पास. नाउ समथिंग न्यू थिंग्स केम इनटू द मार्केट. कुछ नए चीजें आए हैं विथ न्यू फीचर्स. देखें, ये चीजें हम जो आज सीख रहे हैं, राइट, ये बहुत सारे लोगों को नहीं मालूम है. दैट्स द रीजन आई एम टेकिंग द सेशन, राइट? So these are called as alternative investment. Something opposite of your traditional investments are called as alternative investments. Okay. Any other question on this slide?
So only private limited companies will go for this type of funding, or public limited companies also go for this type of funding?
We are talking about like private equity funds who are mostly focus on this kind of thing. They want to be like keep themselves very close. They don't want to be transparent to the outside world. That's the reason they invest into another private equity companies. So that's a reason they are named as a private equity.
Got it. Thank you.
Okay.
Okay, so The management fees which you said, like it is mentioned under the LPA, Limited Partnership Agreement. So there will be also called PPM, right? Private Placement Memorandum.
Yeah, you can call it as the private placement memorandum, LPA or PPM, private placement memorandum. Yeah, correct.
And could you please explain and like fund of fund definition?
I think in the going forward in the next slides I will discuss.
Okay, fine. Thank you.
Okay, let's move on. If you guys have any questions, just shoot in the chat also. I'll take all together. Now, now this slide will speak about the differences between private equity fund or hedge fund. I would also, you can also consider in place of hedge fund, you can also assume mutual fund also. Okay, these are the all the. Just a moment, guys. Let me close it. These are the points we have already discussed. We'll just touch base on that. Private equity funds are long-term in nature. So whoever thinks that they can't wait to get their money back, they should not invest into private equity funds. In case of hedge fund and mutual fund, it's a short term. Why we are saying short term? If somebody is interested to get their money back and looking for short returns, like for example, I've got some bonus amount from my company. I want to invest it somewhere, and within the 6 months, I want to take that money back. So such people who are looking forward for less tenure and they want to get their money back should not invest into private equity, because they follow the long-term nature wherein they are following the cycle, right? First, they are following the commitment cycle, then investment period, then harvesting period, which is coming after minimum of 3 to 4 years. So that's the reason private equity fund always follow the long-term approach. While talking about the type of fund, there are always debate and confusion among the people, like what do you mean by closed-ended fund? What do you mean by open-ended? The definition is very simple, guys. Open-ended fund is nothing but it is a kind of fund wherein you can invest anytime. Anytime you can come into the fund and you can go out of the fund if you are not interested. That is called open-ended fund. And there is no lock-in period, I would say. In case of closed-ended fund, there is a lock-in period. Okay, lock-in period. What do you mean by lock-in period? This kind of funds, mostly into the private equity, they do not allow you to take your money back for a certain period of time. Say, for example, 3 years to 4 years. Those are the people, experienced folks, so they know that they invest into tax-saving mutual funds, right? So minimum amount they have to keep, that is 3 years. 3 years lock-in period would be there in order to get the tax benefit out of a mutual fund. So that is called closed-ended fund. Here you can't come into the fund anytime. Whenever they are allowing, whenever they are opening, whenever they have a good, whenever they have a closings, then only you can go into this kind of funds. Otherwise, you can't enter or exit out of this kind of closed-ended funds. So private equity funds mostly kind of closed-ended funds, which will not allow people to come and go anytime whenever they want. About the investments, we have already discussed. Private equity funds invest directly into the private companies, or they can buy the stake in the public companies. Can you give me example? What would be the form? What would be the call when they take the controlling interest into any public company?
IPO, we can say. So
No, in the things what we have discussed just now in the previous slide. In the previous slide is discussed, we can take the stake of the company in 2 ways.
It's a management buyouts and leverage buyouts.
Yeah, that's right. It's about the management buyout and leverage buyout. So you should guys remember this, right? So by way of going into the following the strategy, they would have the controlling interest into the public limited companies. While we are talking about the mutual fund, they invest usually anything and everything. They can invest into the commodities, future, derivative, bonds, equities, whatnot, real estate. So basically, wherever they see that they can get the profits, they can get the good returns, they would invest. While if you talk about the private equity funds, they are very safe. They play very safe, and they would follow a specific strategy of, and they would focus on investing into most of the time into private companies only. But in case of hedge fund, they invest everywhere, and in order to get the more returns to the investors. That is why comparatively performance fees will be very high in case of hedge funds comparatively. Capital invest as and when called upon. We just discussed about the private equity. They would take the commitment, and if someone is giving a commitment of 20 million, right? The fund will not call the 20 million at a time. They would call in the structure wise, like a timely basis, and that each period whenever they are calling, that particular point is called capital call. They would do a capital call wherein they would say, they would inform all their LPs to pay like 10% of their commitment. For example, if somebody has invested 20 million, how much would be the 10%? 10% of 20 million?
2 million.
2 million, right? So 2 million they have to give. Somebody is committed for 50 million, he would give 5 million. So that is called capital call or the drawdown. You can write it down if you want. That is called capital call or drawdown. In case of hedge funds and mutual fund, what would happen? You can directly go to the company or find a broker and can start investing into any of the hedge funds directly. And it can be one-time investments also. One-time investment. Like for example, if you have got a bonus from the company 50,000, then you can take all the money and you can directly dump into the market, into the any hedge fund or the mutual fund. You can directly invest. Transferability, like how the transfer would happen, is there a possibility? So private equity funds have a lot of restrictions. They can't go out of the fund easily. If they really want to go out of the fund, they have to get someone else. If they really want to go out of the fund, they have to get some replacement. They can't just say, no boss, I'm not interested, can you give me money back? No, it will not happen here. Because you have committed so and so amount, you have to be there into the fund for a certain period of time. But in case of hedge fund, what would happen? You can directly go into the market and sell it off your stake. Because most of the hedge funds or the mutual funds are also available into the stock exchange. Or you can directly go to the fund owner or the company and you can tell them, boss, I want to redeem my shares. Okay. Any questions, guys? Assuming no questions. Okay, this also related to the previous point. Hedge funds are very liquid in nature. Liquid is nothing but you can convert that easily into the cash. For example, I'm the hedge fund investor, and today I'm in need of some money. I wanted to buy a car, and I have some investment of 5 lakhs into the market. So what I can do, I can just simply go to the website and simply place the request, or I can directly inform my broker that I want my money back by tomorrow. That's very easy. In case of private equity fund, it is not going to happen. If you want money, you have to wait till the 3 years or 4 years, whatever the lock-in period they have mentioned. Or you have to find some other ways. You can't take out from the private equity fund. So that's the reason they are very illiquid in nature compared to hedge funds or the mutual funds. Risk, They are more riskier. Hedge funds are more riskier because as you have seen, they are investing in everywhere, wherever they want, they are investing. So there would be high risk involved when they are investing into all the kind of securities, and a lot of diversification is also one reason of it is being more risky, or it is getting you less returns. But in case of private equity, it is less riskier because they are following one particular strategy. They are maintaining some focus where they have to invest. So that's the reason they are less riskier when compared to hedge funds. Hedge funds, again, no specific term. The fund keep running as long as everything is going fine. People come, people go, and the fund goes on. Perpetual life kind of structure. Whereas private equity funds, they usually have a life of 10 to 12 years, but can be extended for a couple of years. So you can say maximum of 15 years, any private equity fund would be liquidated and get closed. What would happen if the somebody wants to continue with the company? They would float a new fund into the market. They can continue investing into the new fund, but it has a life, and this fund get closed after a certain period of time. Control over the assets in both the cases, it will not be there. But again, at least in case of a private equity fund, you can assume that you have a good control over the operation or the asset management. They would timely basis, they would take your opinions, but you are not a decision maker. As an investors, you are not a decision maker, but they do take your opinions on certain things. But in case of hedge funds and all the things taken care by the portfolio manager themselves. Yeah, any questions on the difference between private equity and hedge fund? Or it's all clear?
Clear, sir.
It's all good. Okay.
So,
I assume this I'm going good.
Sami, one question. In these differences, like the first difference you mentioned, right?
Yeah.
P is for long term, HF is for short term.
Yeah.
And in this slide, like you mentioned, no specific term or something. Can you explain both?
Yeah, that is in terms of about the LP from the LP side. If you are thinking that's the thing. Here it's a life of the fund. This is about the life of the fund. And if you are going to the back slide, yeah, this if you are talking about, it's a kind of investment strategy, I would say. Here, if someone who is like long term in nature, like in terms of returns. For example, if I want to get returns in the short term, I should not expect and should not come into the private equity fund. So it is approach more of a in terms of returns I am getting. So if I'm thinking for a getting a return very short period of time, that's not possible in case of private equity fund, because they would give you returns only after couple of years when they are into the harvesting period. Okay, so this is about the returns, and this is about the life of the fund itself. This is about the life of the fund. This is not about the returns.
Okay, got you.
Okay. Okay, this is very important, guys. Those who are willing to make their career into private equity side, they must know what do you mean by waterfall. So waterfall is nothing but it's a method by which returns are given back to the LPs and GP. Like how much is to be allocated between LP and GP? Who will get how much share? So this everything would be decided and done in the form of distribution waterfall. This is called as waterfall distribution or distribution waterfall. And as a basic knowledge, this thing is enough. Knowing that there are two types of distribution waterfall method. One is European, one is American model. What would happen in case of American model? First we'll discuss. I think then we can discuss about the European model. In American model, what would happen is For example, if my fund is investing into some 5 investments, 5 A, B, C, D, E. My fund name is, you can say, PE fund. My fund name is PE fund. I am the owner of the fund. I am the GP. I will take all the decisions. And my fund name is PE fund. And I have invested into 5 companies, A, B, C, D, E. In case of American waterfall method, what would happen? The calculation of waterfall would be done on a deal-to-deal basis. Each of these investment is called as a deal, and as and when I receive from any particular deal, I will start calculating and I'll distribute amount between LPs and GP. Okay, that is called waterfall method. For example, I've talked about the 5 companies investments I have made. For example, company number 2, that is the company B, is giving me certain returns, certain distribution, that is called as a distribution. They will give me some amount. They are giving me, say, 5 million amount as a fund back to me. Now, what I do, I have to calculate the waterfall distribution method, and I have to give it back to the LP and GP. So I am doing here calculation on the basis of deal to deal. I'm not bothered about whether A has given or not, whether I have made the investment into C or D or not. I'm not bothered about that. So I'm doing calculation based on the returns I am getting from each of the deal or each of the investment. That is about the American. Coming to the European model is more of a fund level calculation. What do you mean by fund level calculation? I have to consider how much I am getting from each of the deals, whether from A, from B, from C, from D, how much I have to give to each of the party I have to consider in case of European model. Okay, so what would happen in European model, European model, what would happen? First, you have to give back to your, okay, I think on the next slide I have. Okay, this would happen on the European model. First, they would give back your money back. For example, if somebody has invested 10 million, somebody 30 million, somebody 40 million, the fund has to make sure that they have to pay back this principal amount first. Second stage, they would collect money from all the deals, and they have to make sure that you are paying the preferred return, which is 6 to 8% again. And in the catch up, it will decide how much LP would get and how much GP would get. In the very recent, I've seen that LPs are getting a big percentage again. LPs are getting some 80% and GP would get 20%. And in the last phase, which can be termed as split phase, this catch-up phase amount or the ratio would be reversed out, wherein LPs would receive 20% and GP would receive 80% of the returns. So this is about the European model. This is the model which is very favorable for the investors. What's the difference between this model and that model? This model is more of a guaranteeing you the returns or principal back at the very initial stage. As a first step, when the fund is running good, you are getting your principal back. You are getting your minimum returns back. You are getting some good returns. But in case of American model, what would happen? As soon as you start receiving from the deal 1, for example, deal B in our case, right? So you have to start paying the money to your GP, which is not happening in case of European model. In European model, GP will not come into picture till this third stage. So that's the reason more of the investors would like to follow European model, not the American model. Hope I'm making some sense here. Can you read this? This structure allows for the managers to get paid prior to investors receiving their preferred return and 100% of the invested capital. So this is very GP friendly, manager friendly, and this is LP friendly. So that's the reason a majority of the investors or the funds would follow this method of calculating the distribution. Any questions on this? Yes, no?
Guys, please feel free to ask questions if you have any.
Sami bhai, just a little clarification. As you were saying about this, can you just please go to the last slide?
This one?
On the, yeah, this one. So you said that return on capital, if somebody has invested 100 million, the first that investor will ask for the return on investment, that will be principal amount, right?
Correct, correct.
After recovering that, then they will think about the ROI. What are the agreed ROI is
Correct.
there? Okay. Then they will come for their equity share if he wants to take the exit.
No, this is not the exit. This is the kind of waterfall method every private equity fund would follow.
Okay. Okay.
Yeah. In this stage, you can say this is a pre-final stage wherein LPs would get a lot of money. And in the final stage where they will try to close everything they want to, that would be happen in the split phase. And there would be certain limit here when they are calculating 80% and 20%, right? There would be some limit would be there. There would be a calculation in between. They have to follow.
Okay. Okay, sir. Thank you.
Anybody else? Somebody writing in the chat also. American one, repeat. American, as I mentioned, it's a deal-to-deal calculation rather than doing or collating money from all the investments. It would calculate on the deal basis. Deal in the sense investment. If I'm getting from money from or returns from any one investment, I will take money from that and I'll start calculating or distributing money between LP and GP. That would happen in case of American model. So what's happening in American model is very initial stage, GPs started receiving the returns at the very pre-stage of the fund. While in case of European, they are following some procedure or the different line items they have to go through. Okay, what are the other tasks related to private equity fund? Apart from like doing cash reconciliation, you have to book all the journal entries into the books, into your whatever the software you're using. You also have to prepare financial statements. What do you mean by financial statement? What all come under financial statement? I always say this: balance sheet, your income statement, and cash flow statement, and your statement of partner's capital. That would be a part of your financial statements. Basically these four things are called as financial statements: balance sheet, your income statement, cash flows, and statement of partner's capital. And there would be something called as footnotes. You guys can like refer, go to Investopedia or the any site, a good site on the Google, you can find the information. And issuing a partner capital statement, it is very important thing. Those who have invested into mutual fund, they know it this that every monthly you will get to know how much you have invested, how much your closing balance was, and how much you have purchased and make sales in this particular month, and what is your ending balance. That statement is called partner's capital statement. So as a fund accountant, it is your duty to prepare this and supply it to all the investors, telling them, boss, this was your opening balance, and you have bought these many shares, and you have made sales of this much, and you have got so and so profit and expenses, and at the end your value is this much. So that is called partner's capital statement. And there are many things from the regulatory side also, which we have to report as a part of private equity funds. So there are certain things which you have to report monthly, and there are certain things which are quarterly also. Auditors, each of the private equity fund and hedge fund gets audited. Okay, so they would come up with a lot of questions. auditors, right? KPMG, PwC, Deloitte, they would come with a lot of questions there. Okay, and there are a lot of requests would come from the auditors at the end of the year. So we have to do that also as a fund accountant. Tax preparation, because tax is charged at the individual level. Most of the companies would give this service also, wherein they do all calculation, because your fund is giving them income, right? Whatever the money you are giving them back, you know how much you have given and in what form, whether it was a form of dividend, whether a form of interest, what kind of income you have given, you should know that, and based on that information you will prepare their tax files. That is called tax preparation. So this is one of the activity as a fund accountant you should be knowing and doing. Yeah, any questions on this? So this is the typical life of a private equity fund accountant. You have to go through all these things what we have on this slide. There are many other things also, but these are the core and primary things which a fund accountant of private equity should know and should be responsible for doing it.
Excuse me, sir.
Yeah.
Can you explain me audit request, sir?
Audit request is nothing but, for example, what auditors do, when they are doing auditing for any company, what they do, they would pick up some samples. For example, your fund has called some money, like 20% of the capital call in the month of June 2021. What they do, they just pick up that particular capital call, and they would ask you as a fund accountant to give you all the details related to that particular capital call. So you have to provide them, like how you have calculated, what are the mails associated with that, what is the calculation Excel file you have to give them, and you have to give them the bank statement where this money was shown. Everything you have to provide. So providing this kind of backups or supports, that would all come under audit request. Make sense? Any other questions, guys?
Sami, there is a question in chat box. Can you please elaborate on the tax LP level and fund level?
Your voice is not clear. Can you repeat that again or type in the chat?
There is a question in chat box.
Okay.
Am I audible? Yes.
Yeah.
So can you please elaborate on the tax reports at LP level, GP level, and fund level? Tax reports at these levels.
Good question, actually. So when we are talking about the private equity fund, guys, there would be no taxation happen on the fund level. Tax would be applicable to only LPs. Tax will not be there for the LP level. That's the reason. That is the reason they are following LP kind of structure, partnership form of business in Indian context. If I have to tell you, when you were preparing accounts for partnerships, right? You must have seen that there is no tax applicable on the partnership firm, but rather tax would be applicable on each of the partners' income. The same thing here also happens in the private equity funds. Tax would be charged to all the LPs, not at the fund level. Fund is not liable to pay any taxes. Okay. So GP taxation would happen at the GP level. GP also, if GP is also receiving some kind of income from the fund, then definitely the GP also is liable to pay taxes similar to all the LPs.
Okay, so further to this, we also have one replacement, right? Relating to closings, we also prepare one calculation called equalization, where the investors are coming in to adjust the capital.
Yeah.
Equalization method.
Different. Yeah, that's very important point again. There is some term. Can you go on mute?
Yeah.
Okay, thank you. So there is one concept, guys, I think I have not covered in this. There is concept called equalization, wherein suppose there are 5 people who have joined the fund at the inception, and they were the first people who were the part of first closing. Fund is started, everything is running smoothly. 3 more LPs joined after 6 months. Now, the people who have joined early into the fund, they should have some kind of premium, right? They should have some kind of privilege over the new investors. So for that, there is something called as a concept is there called as equalization or rebalancing, wherein the new people coming into the fund, they would give some amount as a premium to the old LPs. Okay, so that after paying that amount, the fund becomes like that it will assume all the people came at the same time into the fund. That is called equalization. After paying this premium by the new investors to the old investors, the fund will become as if every investor would have come into the fund at the same date. So that particular concept is called subsequent interest, or it is also called as equalization. And each of the closing, it will happen like second closing, third closing is happening. So in our example, 5 people came first, 3 people joined later, 8 people, right? In the third closing, if 4 more people are coming, so these 4 people has to give premium to the first closing and second closing LPs. Like total 8 LPs they have to pay now. So that in that way, you are equalizing all the LPs as if everybody came on the same date, and you are giving some kind of privilege to the old LPs who joined the fund at the inception of the fund or the prior to other new LPs. Yeah, I think I am also done. And last thing from my side, as I mentioned in the flyer, right? Very important thing. This fund accounting job is very lucrative in the market, very attractive right now. Many companies are coming into the India, and they are offering many things to them. They are giving the opportunity. They are first and foremost important for every one of us. They are giving some attractive packages. People who are working into in this industry know that kind of packages they are getting. People are jumping from one company to another because they are getting some huge offers. So it's a kind of phase, guys, wherein you are in demand. You can tell them company what you want. If you are looking for some good package and you have certain number in your mind, and you are a very good person in terms of like knowledge and all, then definitely companies are willing to pay you whatever figure you have in your mind. I'm telling you, in this industry right now. And second thing is growth structure. Based on your performance, based on your knowledge, they are giving you like a lot of promotions. Earlier, it used to happen like people used to get team leader kind of thing after 4 years, 5 years, like that. Right now, if you are performing well and you have experience of only couple of years, still they are giving you the growth based on your skills and knowledge set. Third thing is about your abroad opportunities. Earlier, we didn't have much opportunities. Only few people used to get the opportunity to move abroad to the companies, to the countries like the USA and Canada and other Luxembourg or the any other good countries. Now, there are a lot of opportunities coming because many financial companies are coming up with a new fund each day. Each day, I'm saying, not each month. Each day, they are floating new funds into the market. So they need more people who can manage their funds, who can do the accounting, who can take the decisions. That's the reason we are now short resource into the market. So for that reason, they are calling people to settle down in the foreign countries for some good period of time. So earlier we used to think and we saw it's happening for only people into the technology side and all. No, right now it's happening for finance people also. It's just that you need to have right kind of experience and a good set of knowledge, right? So future is ahead of you guys. It's just that you need to show right kind of interest. You need to be some kind of committed and dedicated towards your future. And this is not very hectic also, I'm telling you guys. When compared to other jobs and all, this is not so hectic that you're not getting a time at all to talk to the people, not lifting the phone, nothing like that, guys. I'm telling you. It has a decent activities. If you are working for the full day, like 8 to 9 hours completely, that should be enough in most of the cases. As and when required, you will stay back and you will complete your work. But that would not happen on each day, I would say. Everything is there, just that you need to have the right knowledge and skill set. With that, I wish you all the best, guys, and looking forward many people like entering into fund accounting side. Do learn from the internet also. Just Google it out, you will find the things. I tried to I tried myself from my side to make the things clear. I hope you people got something out of it. Yeah, that's it, guys. If you
So,
want to reach out to
here,
me,
adding to the Samit bhai point, I would encourage all the people. Previously, we used to have one or two or a maximum 2 to 3 companies, but nowadays so many companies are coming, especially to Hyderabad,
yeah,
who is offering this job and process.
correct. Any questions, guys? You are silent. Is it like you got anything or got nothing?
Hello.
Yeah.
So, Sami bhai, sorry, I joined late. Can you explain what is fund accounting?
No, I can't. There will be recording shared. You can refer to that. Okay.
So this recording will be uploaded to YouTube or it will be sharing in US?
Yeah, our admins, can you quickly share the website, like our YouTube channel name?
Where can I get the recordings?
We will give you in the chat box. Quickly take a look at it.
Yes, I mean, we'll be sharing YouTube channel link where they can refer for recordings.
You have to give it right now before they go.
Yes, doing that.
Just go to this page, guys. Career Guidance Council. You will find our all videos. I have my previous videos also there on basics of accounting and all. You guys can go to that also, refer that. And I'm sharing my number for the people who are genuine, who has got any questions, who attended the whole session and got some good questions, then definitely you can reach out to me for any kind of inquiry. Don't ask me for the job, because certainly I will ask for the skills. Whenever you ask for the job, I will ask for the skill set.